Home equity line of credit versus home equity loan. Which one actually build wealth faster? So you want to use your home equity to build wealth, but you are not sure which loan is actually the best. Is it HELOC, which is your home equity line of credit, or home equity loan, which I call HELON? They both seems like very similar, but trust me, choosing the wrong one can actually cost you thousands of dollars. So you want to stick around till the end of this video as I break down the real numbers and show you which one helps you grow your wealth the right way. I am Wale Lawal. I'm a real estate investor agent based in Houston, Texas, and I've helped countless of people to use their home equity to build passive income through real estate. And today you're actually getting the exact playbook that I've used to help many clients to convert the lazy equity they have in their property into a cash flowing asset that is bringing them passive income every single month. So what is HELOC and what is E-loan? HELOC, which stands for Home Equity Line of Credit, is a flexible credit kind of credit card, you can call it. It's like a credit card and it has a variable interest rate, while home equity loan is a loan and it has a fixed rate. So you can see E-loan as a lump sum of money, like your private loan that you get from your bank or personal loan, and you get that cash, boom, in a lump sum in your bank account with a fixed interest rate that you're going to be paying every single month. Now, here is a quick tips, right? Think of an HELOC as a bucket of cash you dip your hand into as you need it, while E-loan is a sealed briefcase that once you open the briefcase, you have access to all the money immediately. So here is one thing. If you are using equity to renovate a property, you are using it to buy a rental property, or you want a house hack, using the right product can actually mean the difference between growing or being trapped in a higher payment. Let me show you the exactly why. Now, I'll put this right here because this will actually help you to understand the difference between HELOC and E-loan. Majorly is that the interest rate for HELOC is variable, while for E-loan is fixed. Whatever you agree is what you pay every single month. Now, if you want the flexibility of not paying so much interest on any money you don't use, HELOC might be the best way to go. But if you know that, hey, I just need the cash right now and I need to know what my monthly payment will be, then E-loan is the way to go. Now, regardless, if you're looking for a lot of flexibility and still save on interest and you know what you're doing, HELOC is always where a lot of people always go because they don't want to pay interest on the money they did not use. So if you get a HELOC, let's say you get a HELOC of $100,000, you're not going to pay interest on the entire $100,000 if you are only using $60,000 at a time. Once you withdraw it, you start paying interest on whatever you withdraw. Whatever you don't withdraw, in this example, $40,000 left over, you are not going to pay interest on it because you never withdraw it. So the way they do it is that they give you access to the money, but until you move it from the bank, from the HELOC to your bank account, that is when you start paying interest on that money. Compared to E-loan, once they approve the loan, you close on the loan, you start paying the entire interest on the total sum of money you've been approved for. Now, I will quickly walk you through the pros and cons of HELOC. HELOC is very flexible on demand. Say you are doing a property upgrade of $40,000, that will cost you $40,000, but maybe in the process now you see, oh, it's actually going to cost me $60,000 because you have HELOC, right? Let's say you've been approved for $100,000, but you withdraw $40,000 in the first place, you still have $60,000 to go. So as your budget increase, you can easily go back and pick additional money you need to finish your renovation. So if you have done an E-loan, you have to go back to the bank and apply again for anything extra that you need. This is why, again, HELOC might be very advantageous in this situation. So let's say you got a $100,000 HELOC the first time, right? Now you withdraw $30,000 out of that $100,000. All you have to pay is $150 in monthly interest on the $30,000 you withdraw. The $70,000 is still there untouched. You will not pay interest on it because you never withdraw that $70,000. So that flexibility keeps your leverage in check because you don't have to, again, over leverage. You don't have to over borrow money. You only, tap into what you need without paying interest on what you don't need. So here is the cons for HELOC. The interest rate is flexible. It's not fixed. It kind of adjusts every time. So you need a lot of discipline here because if the interest rates move up and your monthly payment payments increase and you don't have the discipline to pay it off quickly, you can find yourself just drowning in interest payment every single month. So this is very, very important if you're going to be using HELOC. So like I said, you need discipline and you have to treat these tools like a credit card. If you don't actually need that money, please do not withdraw it. And if you're going to use this money, use it for something that will actually bring you income. Use it for income producing assets, not a liability. Now, on the flip side, let's talk about the few benefits of your e-loan, which is home equity loan. Home equity loan is very predictable. You know what your monthly payment is going to be. You have the certainty. There is no any surprises, right? E-loan give you that option. Also give you the lump sum money at one time that you can deploy to any endeavor that you want to use it for. And above all, you want to be using this again for income producing assets, not a liability. This is very, very important. This is not the kind of money you go and use for vacation, you go and use to buy expensive wristwatch, or you go and use to just gamble. This is a very serious thing, and I do hope you take this very seriously. Also, the math on e-loan is very simple. It's a very easy math. You know what you're getting, you know what you're paying back. It's very simple. There is no drama, there is no interest rate fluctuation. You get what you get and you pay back what you've agreed to pay back. Now, here's a quick example. Let's say you got a $100,000 lump sum. You got a 7% fixed interest rate. Your monthly payment will be around $65 for about 20 years. Now, here is the cons. This is the disadvantage of your e-loan. It has a less flexibility, and you can also be paying more in costs. You can pay higher costs because it actually it's more like a boxed-in approach. If you only need $40,000 but you borrow $100K, you are now stuck paying, interest on extra $60,000 that you don't need. This is why, again, HELOC might be a better option for you if you know that you're not totally sure on the amount you will need. The key here is to match the loan to your plan. If you know that you want the flexibility and control over the amount you can withdraw, you want to go with HELOC. If you know, hey, I just want the consistency of my payment and I want to know what my payment every month will be and I need this lump sum immediately, then absolutely, and you actually know the amount you need actually. Let's say I need $100K. You can get e-loan for $100,000. Now, both e-loan and HELOC is tied to your home. That's why it's called home equity line of credit. Home equity loan. If you don't have a house that have enough equity, you cannot even implement these two strategy anyway. So you need to have a home, and the home must have at least 30% equity in them for you to be able to implement this strategy I'm discussing with you. Now, both e-loan and HELOC is one of the fastest way to grow your rental portfolio or to even grow your business if you're a business owner, because you can easily access that money that you have paid down or tenant has helped you pay down over time and withdraw the money either in form of a HELOC or e-loan to go and buy another property or another income generating asset. So here is a quick real story of my client. John has a property in Conroe, Texas. This is a single family home, 4-bedroom, 2.5 bathroom. He bought it in 2022. Now he took out e-loan for a renovation. It was a smooth prediction, but he didn't need $100,000. He actually need only around $70,000 to do the renovation. But he took out e-loan. He took out a loan of $100,000 instead of him should have gotten like a HELOC of $100,000 so that he can withdraw the $70K he need and still have access to the remaining of the $30,000 should the renovation budget go above what he predicted. But he just went for e-loan and the entire thing cost him $70,000. Now he's stuck paying interest on the $30,000 that he never used. A HELOC here will have saved him around $200 every single month. At DB, he fully understand the difference between e-loan and HELOC. So as you can see here, if you have gone for HELOC, you will be paying $550 every single month in interest only on the $100,000 because he only used $70,000 out of the $100,000. But because he went for e-loan, his monthly payment is $800 every month. Even though he only used $70,000, he's still paying interest on the remainder of the $30,000 that he never touched. So when should you use each of these, right? This is a summary for you. As I've explained to you, they both have their pros and cons, and you fully want to understand how much do you actually need. If you are not sure about how much you need, then you might want to go with HELOC so that you can can have that flexibility to withdraw more money if you need to, but you don't want to go for e-loan if you need less because you don't know. That's the one thing you have to really consider. So you want to go with HELOC if you are doing multiple projects or projects in phases and you just don't know how much it's going to cost you. You want the flexibility and you are also a disciplined borrower. Now, you want to use e-loan if you already know how much exactly you need and you are comfortable with the monthly payment, like maybe you are replacing a roof, you are paying some heavy cost, you are doing some renovation that are very specific and you know that, hey, this is the budget, it's not going to go above this, or you just need a lump sum money to do something really quick that will, again, focus is income producing asset, not liability, then you want to use e-loan for that, provided you are comfortable with the monthly payments. Now, here is a smart combination that you can actually use if you're a real estate investor or even you're a regular homeowner. You can combine both the HELOC and the e-loan. HELOC can be used for renovation, then you can refinance to a e-loan once the project is done. So that way you have a fixed payment every single month. This will actually allow you to get both the flexibility and predictability without getting stuck in a higher payment when you are still not sure. So you want to make sure you are choosing based on your own plan, based on your goal, and based on your risk appetite, and based on the interest that you can actually handle. So I hope you find value in this video. If you want my personalized guidance on how to leverage your home equity, either to use e-loan or use HELOC, I encourage you to schedule a one-on-one strategy call with me. You will find the link to my calendar in the description below. I will be able to understand your situation, analyze your specific situation, and help you make a smart decision on either you should go for e-loan or you go for HELOC. So let me help you turn down your lazy equity in your home to a cash flowing asset every month for you. Before you go, I want you to watch this video next about Sarah and Marcus, how I help them to go from $0 in passive income to $39,000 every year in passive income, and they started with only $40,000. You're going to be inspired with their story. I do recommend you watch the video here. Thank you so much, and I will see you in the video. Peace.